Congress is about to withdraw the line between a security and a commodity. And that one line decides which crypto Wall Street is allowed to buy next. Here is what actually happened this past week. On May 14th, the Senate Banking Committee approved the Digital Asset Market Clarity Act. The Clarity Act, by a vote of 15-9. Two Democrats, Senator Gallego and also Brooks, crossed the aisle to vote yes. By June 1st, the bill had been placed on the Senate legislative calendar, and as the Senate returns to Washington on June 3rd, a floor vote is expected. Now, I want to be precise, because precision is the whole point of this channel. The bill is not law yet. It still needs 50 votes on the Senate floor. There's an unresolved conflict of interest provision, and it still has to be merged with a version from the Senate Agriculture Committee. Okay, so this is not a fit. This is not a it passed. This is it's at the floor, and the odds just went up materially. I'm Sam, formerly worked at EY, PwC, as a tax consultant, and so on. And the question I want to answer is not one filling your feed right now. Your feed is asking, will this pump my coin? That's the wrong question. The right question is, the one an institutional desk ask is, which token does this bill move out of the SEC's column and into the CFTC's column? Because that single reclassification is the gate. And I'll explain soon. All right. So make sure to like, share, subscribe, comment if you have any question. The promise by the end of this video, you will understand the exact mechanism this bill uses. You'll have a 3-question test to run on your own holdings, and you'll see the real world proof of what reclassification does to institutional demand. Let's get into it. So let's talk about how the bill reprices crypto. So here is the most commentary skips. In U.S. markets, the single most important question about any asset is who regulates it. For most of crypto's life, that question has been a war between two agencies, the SEC, which regulates the securities, and the CFTC, which regulates commodities. If your token is a security, you live under the SEC's disclosure and registration regime, which is heavy, expensive, and for a token, often unworkable. If the token is a commodity, you live under the CFTC, which is lighter and crucially far more comfortable for banks, custodians, and ETF issuers to build on top of. So now the Clarity Act's core machinery is a way to sort tokens between those two regimes. It creates a category called digital commodity, and it routes the category to the CFTC. So the sorting is done with a test built around decentralization, sometimes described as mature blockchain test. The intuition. If a network is generally decentralized with no single party in control whose efforts holders are relying on for profit, it looks more like a commodity than a security. So I hope you understand the difference there, okay? So why does that line matter so much? 3 reasons, okay? Reason number 1, okay? Make sure you're taking notes if you need to, okay? This is a very important video. So first, custody and bank. Regulated institutions need legal certainty about what they're holding before compliance lets them touch it. A clear, all right, this is a commodity, and so removes the single biggest blocker to bank and broker participation. Number 2, ETFs, all right? Spot ETF is far easier to bring to market over a commodity than over a contested security. Clarity on classification is what opens the ETF pipeline. Got it? Number 3, the SEC enforcement overhang. For years, the risk that any given token could be retroactively called an unregistered security kept serious allocators on the sidelines. Take the overhang away and the calculus changes completely. Okay. So when you hear Clarity Act, don't think price catalyst. Okay. Think the gate that decides which tokens institutions are allowed to buy. So now let's talk about the evidence. Let's talk about the evidence. Okay. This is not a hypothetical, we have a live recent case study of exactly what reclassification does. And it happened in the last 6 months. Okay. Case one, the 16 token reclassification and the XRP and Solana ETFs. Okay. In March 2026, the SEC classified 16 cryptocurrencies as commodities. I don't know if you remember that. Okay. That reclassification removed the primary legal barrier to spot ETFs on those assets. The result was subtle. Solana spot ETPs began trading in late October 2025, and XRP spot ETFs launched in November 2025. 7 of them. Once the commodity classification cleared the legal hurdle, if you remember that as well, okay? And the money followed the clarity. Okay, XRP ETFs pulled in roughly 1.4 billion of inflows in the first quarter of 2026. That is the pattern in one sentence. Clarity first, then the products, then the institutional flow. Okay. Once there's clarity, they're in there. Okay. So case number 2, the pipeline behind it. Okay. As of early 2026, there were on the order of 92 crypto ETFs sitting in the SEC's queue with Solana XRP application leading the way. That backlog is the demand sitting behind the gate. The Clarity Act doesn't create that demand. The demand is already there, already filed. What the bill does is widen the gate and put it on a statutory footing instead of leaving it to SEC discretion that can reverse with the next administration. Okay, this is why all this voting is so important. Case number 3, the committee's math. Pay attention to the 15-9 vote that happened this week, and specifically to the 2 Democrats who crossed over. Okay, crypto legislation in the U.S. lives or die on whether it can attract enough Democratic votes to clear 60 votes in the Senate. 2 crossing at committee is a signal that the floor math is closer than the headline suggests. That's the read a vote counter would give you. Put the 3 together: real demand, already filed, a proven clarity to flow mechanism, and improving vote math. That's why this is a positioning event, not just the headline. When I worked in the Big Four, at PwC and later EY, the single most common reason a large institution would not move on an opportunity was not price, and it was not conviction. It was the absence of what we'll call a controlling legal authority. Okay, a clear, citable answer to what is this and who regulates it. Without that answer, the compliance and risk function simply will not sign off, no matter how good the thesis sounds or looks. So I sat in rooms where the clients wanted to act, and the legal side said we can't because the classification is unsettled. That's not caution, right? That's not caution for its own sake. Misclassification is an existential risk for a regulated balance sheet. Okay. So when I look at the Clarity Act, I don't see a meme catalyst. I see the exact document whose legal and risk teams have been waiting for. The thing that turns we can't get comfortable into we're clear to allocate. It's a big jump. That is what reprices an asset class, not a tweet, a classification. Got it? Okay, so here's your 3-question test, okay? Run your largest holdings through it, okay? It tells you which side of the line a token is likely to land. So use these 3-prong test, if you want to call it, or questions, right? So question number 1, control. Is there a single company or small group whose ongoing efforts the token's value depend on? The more yes, the more it looks like a security. The more decentralized and self-running the network, the more it looks like a digital commodity. Question number 2, function. Does the token do something on its own network? Secure it, pay for it, its use, versus mainly representing a bet on a company's success. Native functional tokens sit closer to the commodity side. Now, question number 3, precedence. Okay, precedent. Has a regulator or an ETF issuer already treated it as a commodity? XRP and Solana already cleared the bar. Okay. they already cleared the bar. A token with that footprint is far more likely to land on the CFTC side. Right? So my charge to you this week is run your top 3 holdings through those questions, then watch a Senate floor calendar. Okay, not committee chatter or an actual scheduled vote. A scheduled vote is the trigger that moves positioning. Okay, got it. So to be clear, I'm not telling you, right, any token is going up or down. I'm telling you the line between a security and a commodity is about to be redrawn by the statute. And which side your asset lands on decides whether the largest pools of capital in the world are allowed to buy it. Read between the lines, right? Read it. And you can see the flows before the headline. Wink, wink. This is not financial advice. This is not legal, tax, or financial advice. Please make sure to do your own research. Subscribe if the vote lands, right? The next video breaks down exactly what changed and the tax side of reclassification. Okay, the pinned comment has a question I want you to answer. See you on the next one. Remember, stay blessed. You can, you will, you must. All right? All right.